Welcome to week 3, and in this video we are going to pick up from where we left off in video 2, where we were talking about the estate tax calculation in a nutshell. At the end of that video I mentioned that we would go through some examples, and we're going to take those examples from the lecture on the estate tax calculation from week 2. So in example 1, as illustrated here, we have a decedent that died in the year 2011 with a taxable estate of $4,500,000. We are not trying to figure out what was included in the gross estate less the deductions to derive at this amount. It's just a given. We're keeping it simple for the purpose of your being able to apply numbers to the concepts that we've been discussing and reading. So if you start off with a taxable estate of $4,500,000 in this example, and you add to it the adjusted taxable gifts of $1 million, and the $1 million is also a given amount. But they do tell you in this example that all of the gifts were made in the year 2007, which is important, and they all occurred in 1 year, so they weren't done in multiple years. So if you add the two, one other thing I should talk about before we go further is refresh your memory on what's an adjusted taxable gift. So adjusted taxable gifts are taxable gifts made after 1976 that are not pulled back into the gross estate. And you derive at those taxable gifts by taking the gross taxable gift amount and subtracting out the available unified credit, and thus you have the adjusted taxable gifts to use in calculating your net, getting down to your net estate tax. Adding those two amounts together, we come up with a tentative tax base that's going to be used to compute the tentative tax on the estate prior to any credits or other adjustments, say for instance on the tax on post-76 gifts. The way you derive in this example at the $1,905,800 tentative tax based on a decedent dying in 2011 is we're going to be working with a 35% top marginal bracket because that decedent died in 2011. Remember, if the decedent died in 2013, it would be 40%. So if you take the $4,500,000 in this calculation, multiply it times 35% rate in the year of death, and add it to the base amount of $330,800, you will derive at this amount. That amount's going to be different if we're looking at a decedent again that died in 2013. You subtract from the tentative tax any tax on post-76 gifts. So in this case, there is no tax. Why? Because there's a $1 million gift that occurred in the year 2007. And remember, for purposes of gifts that occurred in 2007, there was a $1 million unified credit that could be used to offset that gift. So if you were to file that gift tax return that would have been filed on this $1 million gifted in 2007, on the Form 709, it would have shown total taxable gifts of $1 million, and then from that amount it would have subtracted the $1 million. Well, let's put it another way. What it would have shown is basically a tax relating to that $1 million gifted amount of $330,800 and an applicable unified credit of $330,800. And so therefore there would be no gift tax, but there would be a gift tax return filed. Subtracting this 0 from the 1,905,000, and of course we get tax before credits of 1,905,800. For simplicity, this example only looks at the unified credit as an adjustment down to derive at the net estate tax. There are actually four applicable credits, but we're only going to discuss the unified credit in this example and the other examples. So how is this unified credit calculated? The way it is calculated, is you take the $5 million unified credit amount that was allowed in 2011. It was $5,250,000 in the year 2013 and $5,340,000 in the year 2014. But we're using $5 million minus $1 million times the 35% tax bracket, and that totals $1,400,000. You add to that amount the base amount of $330,800, and thus you derive at the unified credit of $1,730,800. And remember, the applicable rates to use to calculate the credits are in the code. When you subtract this amount, the unified credit from the tax before credits, you will arrive at the net estate tax of $175,000. To make sense of all of this and looking at this $175,000 and how this whole transfer system is considered unified, we need to understand what does this $175,000 represent? Well, if you have $5 million of unified credit, and if $1 million in gifts were given away, that gives you $4 million left of the unified credit, or $4 million of transfers left to utilize against the remaining unified credit. So if you take $4,500,000 taxable estate less the $4 million that I just mentioned relating to the unified credit that's available to apply to the taxable estate, $4,500,000 minus $4 million, the unused credit amount, you have $500,000 left that's subject to tax. If you take $500,000 and you multiply it times 35%, you will derive at this $175,000 that was the remaining amount that needed to be taxed. So this all makes sense, and you can do the math to make sure that the numbers come out the way they're supposed to, and they will if you've done everything else correctly. So moving on to example 1.1. The facts haven't changed a whole lot, and just trying to get you again used to putting the numbers with the concepts. So we have the same taxable estate and deductions as in that example 1. But since we're in 2013, we're going to, and we have a decedent that's dying, in the year 2013, then we are working with a 40% top marginal bracket to use to apply any of your tentative tax and your unified tax. So the credit that would have been allowed in the year, the total credit available would have been $5,250,000 in the year 2013. And remember, in the prior example, it was $5 million. So to derive at this tentative tax, this time we're just doing the same calculation as example 1, but this time we're using 40%. So we're taking $4,500,000, multiplying it times the 40%, adding to it the base amount for 2013 of $345,800. And when you add those two numbers together, you arrive at this $2,145,800 number. We talked about the tax on the post-76 gifts. There is no tax, although there were gifts because of the exclusion. So when you subtract this amount from the tax on the post-76 gifts amount from the tentative tax, you derive at tax before credits. Again, we're only factoring in one credit, and that's the unified credit. We are not looking at other applicable credits. The way the unified credit is calculated in the year of death is similar to example 1, but based on a 40% rate as opposed to 35% rate. And we're using a $5,250,000 exclusion as opposed to $5 million that was used in example 1. So in this case, you have $5,250,000 minus $1 million times 40% gives you $1,700,000 that you need to add to the base amount of $345,800. When you add those two numbers together, you get a unit, and remember that's taken from the code and the chart that you use to derive at the numbers for the year for death in 2013. And after you do those calculations, you will come up with a unified credit of $2,045,800. And if you subtract that from the tax before credits, you get a net tax, estate tax of $100,000. Making sense of it again, let's just go through it one more time. If $1 million in gifts are given away, as we see up here, there's basically $4,250,000 left of the $5,250,000 unified credit. Or you can look at it a different way, $4,250,000 of transfers left to utilize against the remaining unified credit. So if you take a $4,500,000 estate and subtract $4,250,000 credit available to apply to that estate, that gives you $250,000 left that's subject to tax. $250,000 times 40% is $100,000. See, it makes sense. All right, so let's move on to example 2. In example 2, the facts are going to change a little. In this situation, the taxable estate is the same, but the adjusted taxable gifts are only $900,000, and that's versus the $1 million that we were using in the previous examples. Why is that number different? In this particular example, what occurs is, we talked about this before, there was $100,000 that was pulled back into the decedent's gross estate. And remember, so that means that this $4,500,000 includes $100,000 of the $1 million adjusted taxable gifts that were given in the year 2007, but were pulled back into the gross estate. And so when you now add up these numbers, you end up with $5,400,000 as a tentative tax base. And the reason why you have a lower amount, because you still have the $1 million that you previously taxed, but $100,000 of it went into the gross estate. So you have a tentative tax of $2,105,800, and that is calculated similar to your other calculations. Only thing different is you're basing it on $5,400,000 in this example versus $5,500,000. So if you take $5,400,000, subtract out $1 million times 40%, add $345,800, you derive at $2,105,800. To derive at the $2,045,000 unified credit, your calculations are similar in that you're going to take $5,250,000, subtract the $1 million, multiply it times 40%, and add the $345,800 base to derive at a unified credit of this amount, $2,045,800. You subtract that from the tax before credits, and you get $60,000 net estate tax.